Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pccw Limited Annual Report. Pccw Limited provides a wide range of businesses and services across various sectors. The company's telecommunications segment offers local telephony, mobile, enterprise solutions, international telecommunications, and network-based services. In addition to these core services, Pccw also provides outsourcing and contact center services, IT solutions, and technical consulting and engineering services. The company's media business segment includes free television, pay television programming, interactive multimedia, and mobile video on demand and advertising services through its OTT platform. It also publishes directories, distributes media content, and sells advertising in various telephone directories and online platforms. Furthermore, Pccw offers broadcasting and related services, customer relationship management solutions, and content-related services under the View brand. The company also provides data services, system design, project management, and managed services for businesses. Additionally, it operates a customer loyalty program, sells merchandise online, and engages in content production, talent management, and entertainment business. In recent years, Pccw has expanded its offerings to include e-commerce, travel, insurance, big data analytics, fintech, and health tech services. The company's diverse range of businesses and services makes it a significant player in the telecommunications and media industries. The recent performance of Pccw Limited stock has been a subject of interest among investors. Despite not exceeding a 50.51% increase in the past year, the company's stock has shown positive growth. According to various reports, Pccw's stock price has fluctuated between HK$4.20 and HK$5.83 over the past 52 weeks. Several key events have contributed to Pccw's performance during this period. The company reported a 7% rise in revenue to HK$40.25 billion for 2025, with consolidated profit climbing 35%. HKT, a subsidiary of Pccw, also announced solid annual results for 2025, with a 5% increase in total revenue and a 4% growth in total EBITDA. The media segment, including View and View TV, has been a significant contributor to Pccw's performance. View added 1.3 million net paid subscribers, reaching 16.8 million, while View TV expanded its digital memberships to 3.4 million. Additionally, Pccw Interactive Media Holdings Limited entered into an expanded branding and marketing arrangements framework agreement with FWD Life Insurance. However, despite these positive developments, the stock price has not surged over 50.51% in the past year. Some reports have raised concerns about the sustainability of Pccw's dividend payments due to high payout ratios, and there was news regarding U.S. regulators probing HKT over national security concerns. These factors may have contributed to the limited increase in Pccw's stock price. Pccw Limited maintains a market capitalization of $47 billion, broadly in line with the industry peer group. Pccw Limited trades at a lower price-to-book ratio of -34.63 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 88% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.2%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given summary. On the growth side, several key factors contributed to the increase in revenue. Firstly, Viu's expansion and addition of new subscribers drove significant growth in subscription revenue. The introduction of over 200 new titles, including high-performing content, also played a crucial role in boosting revenue. Furthermore, economies of scale achieved through focus on established markets, the launch of regional streaming bundles with HBO Max, and the introduction of Viu Shorts all contributed to revenue growth. Additionally, HKT's market leadership and innovation edge, continuous upgrades to digital infrastructure, and accelerated integration of artificial intelligence across services and operations also drove growth. On the decline side, several factors led to a decrease in revenue. The pay TV business revenue declined by 2%, while advertising revenue remained stable despite a weak retail environment in Hong Kong. Unsatisfied long-term fixed-price contracts also decreased from HK$35,489 in 2024 to HK$33,788 in 2025. Overall, the growth drivers were largely driven by Viu's expansion and innovative strategies, while the decline drivers were primarily due to market conditions and contract-related issues. The company's debt level has seen a significant increase over the past period. According to financial reports, gross debt rose by 13% from HK$52,393 million to HK$59,180 million. This substantial growth is also reflected in the increase of short-term and long-term borrowings. As a result of this increased borrowing, interest expenses may have changed due to the rise in long-term borrowings. The company's financial situation has been impacted by these changes, which warrant close examination to understand their implications for future operations. The company's performance varied across different segments and regions in the given period. On a positive note, the media segment saw an increase of plus 4.7% in revenue and plus 3.2% in EBITDA from 2024 to 2025. The HKT business segment also performed well with a plus 1.9% rise in revenue and a significant plus 30.8% jump in EBITDA. In terms of geographical performance, Hong Kong, mainland China, and Singapore all recorded revenue growth, with increases of plus 7.3%, plus 9.8%, and plus 11.1% respectively. These regions demonstrated strong market demand and expansion opportunities for the company. However, there were some areas of concern. The businesses segment saw a significant increase in revenue but minimal improvement in EBITDA, indicating potential operational inefficiencies. Additionally, restructuring costs in 2025 amounted to $113 million, which may have impacted overall profitability. Management is optimistic about the company's outlook, citing several key strategies to achieve sustainable profitability. One of these strategies involves expanding its subscriber base through new content releases, including Viu originals tailored to local audiences. This approach has already shown promise, with the OTT business delivering a solid performance driven by Viu's subscription business. To further boost growth, management plans to expand into high-growth Southeast Asia, markets through partnerships with local carriers. Additionally, a new streaming bundle with HBO Max is expected to increase subscriber numbers and expand reach. The company also aims to deepen viewer engagement by delivering captivating content. In the entertainment sector, management expects a rebound in financial performance in 2026, driven by a strong lineup of group concerts and a revitalized talent roster. To elevate the international profile of its artists, the company plans to participate in major productions and global events. Furthermore, management aims to drive growth by broadening monetization channels beyond content and live events. Overall, management's strategy is centered around investing in digital capabilities while considering market conditions. By focusing on expanding its subscriber base, delivering captivating content, and exploring new revenue streams, the company is well-positioned for future success. The company's dividend payment history is a notable aspect of its financial performance. According to the provided information, the company has indeed paid dividends in both 2024 and 2025. This indicates that the company has been committed to returning value to its shareholders through regular dividend payments. The consistent payment of dividends over these 2 years suggests a stable and reliable approach to shareholder returns. That concludes the financial summary for PCCW Limited. Feel free to comment below, and I will be happy to answer them when possible.